Welcome to the Just Word Podcast. I'm Pat Bolland. The Just Word Podcast is brought to you by Justwealth, investing the way it should be, just for you. You know, everybody has in their head a picture of their retirement, but sometimes it doesn't work out that well. How do you avoid a retirement crisis? Well, Myron Genyk is the co-founder and CEO of Evermore Capital, which is a Canadian asset management company, and he'll be joining us right after this. Myron, a pleasure to meet you.
Thanks, Pat. Thanks for having me on the show.
Okay, you recently wrote an article about the 5 things that one should do to avoid a retirement crisis. What are those 5?
Sure. Well, I'll talk about maybe 4 of them, and then I'll throw in a bonus 5th one that I didn't talk about before. So the first one is saving more by spending less. So it's all about building a nest egg, and the less you spend right now, the more you're able to save, the better you're able to prepare yourself. Number 2 is, what do you do with that nest egg? So that's asset allocation is a huge part of it. So asset allocation refers to the mix of stocks and bonds or other things that you have in your portfolio. And asset allocation alone accounts for as much as 90% of portfolio variability of returns. So asset allocation is huge. Number 3, low fee investing. Being in low fee investments means keeping more money for yourself. Number 4, as you're approaching retirement, the longer you work, that means you're drawing down less now. And an extra year of work could mean 3 or 4 extra years of comfortable retirement. So it's a bit of a lifestyle change. If you've always been thinking about retiring at 65 and now you're like, okay, maybe I'll retire at 66. That 1 extra year could add 3 or 4 extra years on. And then continuing on that, so the 5th thing is, speaking of retirement lifestyle, part of avoiding a retirement crisis means thinking about what you want your retirement to look like, thinking about that in advance and preparing for it, and mentally preparing for how much will that cost, what types of things will I do, because a retirement crisis isn't maybe not just a crisis financially, but it could also be a change of life crisis as well. So preparing for that, thinking about what types of activities am I going to do, how am I going to fill my day, and how much more do I maybe need to spend to achieve those goals.
Okay, let's unpack that a little, especially the savings part to start with, and spending less. I mean, that's hard for a lot of people, the spending less part, but savings. What's too late? Is 65 actually too late? Is 60 too late? Is there a line in the sand?
That's hard to say. It really depends on how much you have saved at the moment, what you think you might need to draw upon in retirement. 65 might be too late. I hate to bring that bad news, but if you're 65 and you had 0 saved for retirement, then working an extra 5 years, if you're able to work until 70 and save, I know it's tough, but if you're at the point where you have nothing saved, saving $500 a month could be really challenging. But if you commit to saving $500 a month for an extra 5 years till age 70, then that increases your monthly income. It could increase it by as much as $220 a month until age 90. Okay, so again, wow. Working a little bit of extra. So, it's not much. $500 a month of saving for 5 years could lead to as $220 per month for an extra 20 years. Now, let's say you're not 65, let's say you're 55 and you have nothing. So the math shows that whatever you save per month over the next 10 years until age 65, you could draw down roughly that same amount over the next 20 years. So just unpacking that, if you were to save, say, $500 per month for 10 years from age 55 to 65 and then retire, then you can increase your monthly income and how much you draw down by $500 per month for the next 20 plus years. Now, what if instead of, you're 55, let's say instead of working to 65, you worked till 70 and you're still saving that $500 per month now for an extra 5 years. You go from being able to increase your monthly income by $500 per month to $850 per month. So, a lot of, statistics show that a lot more people are working in retirement, and even just working modestly. You don't have to kill yourself, but even part-time gig or consulting or anything like that. Just what it means is you're drawing down less now, you're allowing your nest egg to continue to grow.
Okay, great concepts, but why wouldn't I just rely on my pension plan, for instance, or what the government is giving me in old age security or other benefits?
Sure. Okay. So in terms of government benefits, the three main ones, there's CPP, there's OAS, and if you're really hurting, there's the Guaranteed Income Supplement, or GIS. If you were to max out, if you were to get the maximum amount of CPP, OAS, and the GIS, you could get over $35,000 per year. That's great. That would be a lot of money, but most people don't qualify to get all three. So to get the maximum for CPP, OAS, and GIS, this depends on a number of factors. It depends on your age, how many years you worked. It depends on your marital status, how many years you've been a resident of Canada, and so on. So chances are you're not going to get $35,000 per year in government benefits. You're probably going to get a lot less, maybe half. The poverty level for a single person in Ontario right now is about $20,000 per year. So if you're relying solely on government benefits, you're probably skating really close to the edge of what is the border between, living below the poverty line or living just slightly above it. So I wouldn't recommend anybody just rely on government benefits for their retirement. Have a little bit of a nest egg saved up and bolster those government benefits with your own nest egg.
Okay. You also talked about low fees, and there are all kinds of places you can get low fees, but the regulators have been watching the fees for a long time, and they want transparency in fees. And yet I seem to find it's hard to find where fees are buried in my statements. What are your thoughts on transparency of fees?
Yeah, so there's a great reform that's in the pipeline right now. Hopefully it comes to pass. What it's going to allow investors, especially investors who have advisors, is to see the cost of their total cost of their portfolios. So it's the cost of the advisor, but it's also the cost of each individual investment. They're proposing that this cost be represented as a percentage of your total investments, but also as a dollar value as well. It's funny that when you see something as a percentage, you might think, 1.5%, that's not bad. But on a $1 million portfolio, say, that's $15,000 a year. And all of a sudden now you're thinking a little differently about it. So what I would love is to see both percentage fees and dollar amount fees for every aspect. Where's all the money coming out? And what is that risk represented both ways? Because you're right, investors are paying way too much in fees right now, and they deserve as much information as possible to help them shop around for the best investment.
Okay. Now, you've convinced me. I have to start putting more money away. What should I look at in terms of investments? Because, so for instance, this year is a great example. Market's been really volatile. I probably don't want to look at the stock market, or I'm reluctant to move into the stock market. Should I put it into guaranteed investment certificates? What are your ideas?
So Warren Buffett's got a great quote that encapsulates how I feel about this, and that's: be greedy when others are fearful, be fearful when others are greedy. Usually, if you look at the market is cyclical, it's ups and downs, generally ups over time. And that's both stocks and bonds. In the very long run, both stocks and bonds experience real positive returns. That's after inflation returns greater than zero in the long run. So if the market's taken a bit of a bite and you have cash on the sideline, now is a better time to be investing in the stock market than a year ago when everybody was euphoric and thinking everything was going to go to the moon.
So I should be greedy now, should I?
Yeah, I mean, greedy to an extent is maybe how I would think it. So like sensible greed. So, again, I wouldn't put it all in a single stock or, on a single commodity. Diversification is important. So greedy to an extent, I would call it long-term greedy, and look to see where can you get the best long-term real returns. But yeah, now's a now's not a bad time. I mean, markets could get worse from here. Nobody knows for sure, but if you're saving for something like retirement, now's a perfectly, now could be a good time to get in the market.
Oh, okay. So you're not recommending GICs. What are your thoughts on interest rates?
Yeah. So to be perfectly honest, I can't make calls on interest rates. I think that the markets are pretty good at telegraphing what the Bank of Canada or the Federal Reserve is going to do in the short run. We're taping this today right before the Fed's announcement. Everybody's predicting 75 basis points. That could be the case, but what interest rates will be at the end of 2023, nobody really knows, and the market's not really good at predicting these things. If you look at implied rates or implied inflation, the price of inflation implied by Treasury inflation protected bonds or real return bonds, the collective market is usually not great at predicting those things. And so I'm not going to think that I'm smarter than the market. You mentioned GICs. GICs, the real returns on those are almost always negative. If you need cash in the short term, if you want cash for, if you need an emergency savings account, or you've got tuition payments coming up in the next few months, things like that, GICs are perfectly reasonable as a short-term investment vehicle. But when you're investing for long periods of time, inflation is going to crush the returns that you can earn on that. The real returns on GICs are almost always negative.
Wow. It's something that I guess people don't realize because of what inflation is doing overall. Speaking of inflation, I've got you here, so I've got to ask, what are your thoughts on gold and Bitcoin, for instance, within the context of inflation for sure, but just as investments generally?
So Bitcoin and gold a year or two ago, or Bitcoin for the last 10 years and gold historically have both been touted as being great inflation hedges. And I mean, you can look to see what's happened in the past 6 or 9 months ever since inflation really started ticking up. Both haven't done so well. Bitcoin and other cryptos have been pummeled. Gold is down maybe 20% or so. So they haven't proven to be good inflation hedges. They're also, people say, in end of world scenarios, they could be used as a store of value. They could be used for transactions. The world is arguably a less safer place than it was before things escalated in Eastern Europe. And despite the escalation of, despite the geopolitical escalation of Russia invading Ukraine and things happening between China and Taiwan, both gold and Bitcoin have fallen. So I'm not convinced that they're great for as a store of value or for transactions, and very just tangentially as well. I mean, Russia's having a really hard time selling its gold to raise rubles or to raise currency. So, I mean, that's anecdotal, but when you have tons and tons of gold and you need to ship it out by train and there's a war going on, gold's not really doing much for you.
And the rest of the world knows that you need to sell gold to finance your war. I get it. Okay. So then, somebody recently asked me what my most expensive item is in life, financially at least. And I answered mortgages, and I was wrong. I guess studies have shown it's taxes. What are your thoughts on investments and how to reduce if not avoid, taxes?
So it's hard to avoid taxes completely. You can't go through life paying zero taxes. I meet all kinds of people who say, I want to pay zero in tax. And I say, well, great, go live in a forest by yourself somewhere. If you want to participate in the economy and society, you have to pay some tax, but there are ways that you can minimize it. So if you're above the age of 18, there's 2 great ways that you can do so. One is RRSPs and the other is TFSAs. And just to break those down really quick, an RSP, Registered Retirement Savings Plan, it's a type of account that you can invest in. It's not just for saving cash or GICs. You can hold stocks, bonds, ETFs, things like that in there. So with an RSP, you contribute, there's a limit. That limit is a function of how much you earn. And you get a tax refund back And so you get rewarded for saving now, and then that money grows tax-free. And then eventually when you take it out, that's when you get taxed on it at whatever your marginal tax rate is. If you're working at a larger company or at the government, chances are you have access to a group RSP. And those are even better than RSPs because your employer will usually match your contribution. So if you're saving, say, $500 a paycheck, they might throw in another $500, and now you're saving even more. With TFSAs, the tax-free savings account, a lot of people say they should have been called tax-free investing accounts, but so they can be used for investments. Again, they can hold things like ETFs. And unless you're a day trader in here, you won't be taxed on here. So this is after tax money. So you get taxed on your income, and then you put money in here, and it can grow, and you'll never have to pay tax on the growth or when you withdraw it. And then another thing is our ESP. So if you have kids and you want to save for their tuition, contributions here are with after-tax dollars, but that money grows tax-free. And when it's eventually withdrawn, if you're doing it right, it would be taxed at your child's marginal tax rate, not yours. And if you're maxing out your RSP, your TFSA, and your RESP, you're well on your way to achieving the financial goals that you've set out for yourself. And more importantly, minimizing your taxes.
Yeah, minimizing, not avoiding, minimizing.
That's right.
That's a good way to phrase it, Myron. Listen, Evermore Capital has a target date funds. Tell me what a target date fund is and why one would have one.
Yeah, so when you're younger, the types of things that you should be investing in, let's look at their stocks and let's look at bonds. And like I said earlier, both have averaged real positive returns in the long run, right? So these are in the long run, when you're saving for something like retirement, they're great. Stocks and bonds are different in many ways, but the important one for when you're saving for retirement, stocks have a higher expected return in the long run, much higher than bonds. The problem with stocks is they have short-term volatility. So they could whip up and down in any given year. They could be up a lot or they could be down a lot. Bonds have a lower expected return, but what you're getting for that is they have less volatility in the short run. So if you're younger and you're trying to build your nest egg, where you want to be is in the stock market. And then when you're older, you want to have a bit more in the bond market. And so when you're starting off, you should be close to 100% in equities. And when you're in retirement, maybe something more closer to 50-50. And what a target date fund does is when you invest in a target date fund, and if you're, say, 40 or 30 years from retirement, that fund will be in a portfolio that is highly concentrated in equities. And then over time, over the years and decades, the amount that's invested in equities decreases and the amount that's invested in bonds increases. And so what a target date fund does is it manages that asset allocation for you. So you can be as hands-off as possible. And if you have no interest in managing asset allocation or thinking about what does that mean, the target date fund does that on your behalf. And so a target date fund is essentially a one-stop shop for retirement investing.
Wow. Is it actively managed or is it on some kind of a formula?
Yeah, so most target date funds are not actively managed. They're rules-based. And so they follow what's called the glide path. The glide path refers to the change in asset allocation over the years. There are additional rules around rebalancing because sometimes things go out of whack. If stocks outperform bonds massively in a month or vice versa, then the portfolio managers work to rebalance the portfolio to get it back onto weight. Usually rules around that. There can be rules around currency hedging. So Evermore retirement ETFs, like most target date funds, employ a rules-based strategy because, if you tinker around too much with it, and if you try to make active decisions and picking sectors or picking, duration along the yield curve, if you're trading bonds, the more you tinker with it, the more things can go wrong. So what we looked is at the historical data and what is the best way for us to manage the target date funds so that investors can enjoy a retirement that's comfortable and secure.
Interesting. Myron, thank you so much for your time and ideas.
Yeah, thanks so much, Pat. It was great talking to you.
Okay. Myron Genyk is the co-founder CEO of Evermore Capital.